So first question is, are a lot of people leaving money on the table? There are so many programs out there, VA, which you have to, be a veteran to qualify for, FHA, USDA. How do buyers know what they actually qualify for and what is actually best for them? Meaning, if I came to you and I said I need to get a mortgage, I would just assume that I'm going to get a conventional mortgage, but I might be able to get a better deal by getting an FHA or doing some special financing or possibly getting an adjustable rate mortgage instead of a fixed rate mortgage. How does somebody know what the heck they're supposed to do?
So many of these programs have a lot of different caveats, especially first-time homebuyer programs, to where you're not going to know right away from a generic conversation if they're going to fit the bill for that.
Right.
So while we're going through the actual loan application process, I'm dissecting what might be a good fit. And at the end of the conversation, we might give them 2 or 3 ideas and see what their level of comfort is for each one. Just try to help them pick from all the different options.
There are so many people out there who they just don't have enough money to make a down payment. They have enough money to make the monthly payment because they're paying more in rent than they would probably pay on their payment in their home. So are there state and local down payment assistance programs available? And if there are, how can somebody find out about them?
So the easiest one is to talk to your loan officer.
Okay.
You can obviously go and Google. It'll send you down a rabbit hole. There's a lot of different things out there, but your local lender, like myself, is going to be able to know exactly what programs you're going to be able to look at, because so many of them you might not qualify for. Like I said earlier, there's so many little caveats to each one of those programs. There's 3 or 4 that encompass the entire state, and then a lot of other ones are all county specific.
Okay.
So you have to really do your homework to be able to know what's going to work and what won't.
There are things that buyers can do during the process of getting a loan that can turn them from a winner, unfortunately, into a loser. What would you say is the most common mistake you see people make during the process of getting approved? Meaning they're all good, they get approved, they get pre-approved, and then before they can get that loan closed, they do this, and it just totally derails the process.
I think it's 2 things. One is they don't know that they can't go open up new lines of credit, whether that be a new credit card, personal loan, automobile loan, and also they forget to keep making their payments. So I see both of those pop up.
Meaning they miss a payment after they've kept their record spotless for a few years and then they miss something? Oh my gosh. So I have heard that the type of mortgage you have describes the type of person that you are. I don't know if that's true, but for example, some people swear by fixed rates, others like adjustable rates. I've had both in my life. What does someone's choice about a fixed rate or an adjustable rate to say about a buyer and possibly their financial style or their personality?
I think it's personal preference.
Okay.
It's what they believe the market is going to be doing.
Yep.
And in most cases, you're going to see the majority of people gravitate towards a fixed rate mortgage.
Yep.
It's locked in, it's steady. There's not going to be any change to the rate unless you choose to change it.
Yep.
Whereas for an adjustable rate, that is a little bit of a gamble. So it'll be fixed for a specific amount of time, and then it can have its ebbs and flows depending on what the market's doing. So you are doing a little bit of a gamble there, but there are specific scenarios where that can make sense. It's just all personal preference for your ideology and what's going on in your finances.
Yep. And I've had some adjustable rate mortgages in the past and they work fine. And let's just say I could save 1%. I could go from 6.75 to 5.75. I don't know if that's accurate. I'm just playing here. For me, it would all be determined how long I'm going to stay in the house. So if I can get a 5-year ARM or a 7-year ARM or 10-year ARM and maybe 3 years, I don't care. What do you say in closing here is basically the biggest difference for buyers in 2025 compared to buyers in, let's just say, 2019?
I think right now the rates are so much different, and you're seeing a lot more scenarios when it comes to qualifying that there's extra layers to guidelines just to kind of protect the borrower and to protect mortgage in general. So it's just a different environment altogether, but definitely the rate change more than anything. Rates have definitely changed a lot since 2019, and they're going to continue to change up and down.
Yep.
So it's just a different environment.
And really the safeguards that were put in place are really designed to create stability in the market.
Correct.
So we don't have 2008 repeating itself all again.